You know the trade. It finally starts moving in your favor. Not a huge move, just enough to give you that feeling that maybe this one is working. And almost immediately your hand wants to close it. Not because your target was hit, not because your plan says exit, just because you feel exposed. So you take the profit. Small, safe, clean. For a second, it feels smart. Then later, the opposite happens. A trade goes against you. It reaches the point where you know, deep down, it should probably be closed. But now closing it feels worse than holding it. So you wait. You widen the stop a little. You tell yourself the setup is still valid. You look for one more reason to stay in. And before long, the small loss you could have accepted turns into the trade you can't stop thinking about. This is one of the strangest patterns in trading. You cut the trades that deserve time, and you give extra time to the trades that deserve to be cut. And if you're newer to trading, this can feel deeply confusing, because on the surface, your behavior almost looks reasonable. Protect the profit. Give the trade room. Don't overreact. Be patient. All of that sounds intelligent, but in practice, it often destroys your results. What makes this especially frustrating is that you usually know what you should do. You've heard it 100 times. Cut losers. Let winners run. The advice is simple. Almost too simple. And yet, when real money is on the line, the simple thing becomes unbelievably hard. That's because this is not mainly a knowledge problem. It's not that you don't understand risk management. It's not that you've never heard of expectancy. And it's not always that you lack discipline in some broad moral sense. What's really happening is more uncomfortable than that. Your brain is trying to protect you. The problem is that in trading, the thing that feels protective is often the thing that causes the damage. Your brain reads unrealized profit as something you might lose, so it urges you to lock it in. It reads realized loss as something painful and final, so it urges you to delay it. In other words, your system starts chasing emotional relief instead of good decisions. And once that pattern starts, it can quietly take over your trading. In this video, we're going to break down why this happens, why it gets worse over time if you don't deal with it, and how to build rules that help you trade from a plan instead of from momentary relief. Because until you understand this mechanism, you'll keep blaming yourself for behavior that is actually much more predictable than it looks. A lot of traders think their biggest problem is analysis. They assume the answer is a better indicator, a cleaner entry model, a stronger confirmation, another course, another setup. And analysis does matter. Of course it does. But many traders are not failing because they can't identify decent setups. They're failing because they become two different people before and after they enter a trade. Before the trade, you're calm. You can mark levels, define risk, set targets, talk in probabilities. You understand that not every trade will work. You can even accept that losing is part of the game. Then the trade goes live and something shifts. Now the chart is no longer just information. It feels personal. Every candle starts meaning more than it should. A small pullback in a winning trade feels threatening. A small bounce in a losing trade feels hopeful. The same market you were reading objectively 5 minutes ago now starts pulling on your emotions. This is the split that hurts traders most. Clean thinking before entry. Distorted thinking during exposure. That's why so many people can explain good trading and still fail to do it. When you're flat, you think like a strategist. When you're in a trade, you often think like someone trying to escape discomfort. And if you've experienced this, you know how subtle it is. It doesn't usually feel irrational in the moment. It feels justified. You'll say things like, "I'm just being cautious," or "I don't want to let a green trade turn red," or "The market is just shaking people out," or "I'll close it if it loses this level." Then it loses that level, and suddenly there's another level. This is why traders get trapped for so long. The behavior doesn't arrive wearing a sign that says emotional decision-making. It arrives disguised as prudence, patience, flexibility, and market awareness. That disguise is powerful, because if the behavior looked obviously reckless, you'd catch it faster. But cutting a winner early can feel responsible. Holding a loser can feel mature. You tell yourself you're avoiding being too mechanical. You tell yourself you're giving the market room to work. You tell yourself you're reading context. Meanwhile, your execution is drifting further and further from your edge. And this is where newer traders often become discouraged. They start thinking, maybe I'm just not built for trading. But what they're seeing is not a character flaw. It's a very common psychological pattern triggered by uncertainty, money, and exposure. You are not only trading the market, you are trading your own reactions to the market. This is the part that confuses people the most. A losing trade should feel dangerous. That makes sense. Money is being threatened. The position is going against you. So why would the winning trade also feel uncomfortable? Because once you're in profit, your brain changes the story. Before the trade moved in your favor, the profit was theoretical. It was just part of the plan. But once you see green on the screen, it starts to feel like something you own. And the moment you feel like you own it, the possibility of giving it back becomes painful. That's why a winning trade can create tension instead of confidence. You're not just thinking about what you could make anymore. You're thinking about what you could lose from what you've already seen. Even if that profit was never locked in, your brain treats it as yours, so the emotional pressure increases. This is why traders often close profitable positions long before their target. Not because they've suddenly become stupid, not because they forgot the plan, but because the feeling of potentially losing open profit is emotionally stronger than the logic of following the trade to completion. The internal dialogue sounds familiar. Just take it. You can always re-enter. Profit is profit. There's nothing wrong with securing something. And again, the problem is that each of those statements contains some truth. That's what makes them dangerous. Yes, profit is profit. Yes, sometimes taking something off makes sense. Yes, there are times when re-entry is possible. But if those phrases become emotional escape routes rather than planned actions, they start training you to abandon your edge the moment discomfort appears. Now compare that with the losing trade. When a trade is losing, closing it means accepting something final. The pain becomes real. The mistake becomes visible. The analysis might have been wrong. The money is gone. And the act of closing the trade forces you to face all of that at once, so your brain looks for a delay. Maybe it just needs more time. It's near support. It's oversold now. It already moved too far to close here. Notice what's happening. In the winning trade, you rush to make the feeling of uncertainty go away. In the losing trade, you delay the moment that would make the pain real. In both cases, you're not managing the trade. You are managing emotion. And once you see that clearly, a lot of your past behavior starts making sense. Most traders think psychology is about mindset in a vague sense. Confidence, discipline, patience, emotional control. Those words get repeated so often that they start to lose meaning. But the issue here is more physical than most people realize. When a trade is moving against you, your body often reacts before your reasoning catches up. Your breathing changes. Your focus narrows. You check the P and L more often. You stop reading the chart and start reading your own discomfort. That's not random. Your nervous system is built to detect threat and push you toward relief. In normal life, that can be useful. If something is dangerous, quick action matters. But markets create a very strange environment. They trigger the same threat circuitry without presenting a threat you can solve in a normal human way. You can't argue with the market. You can't overpower it. You can't force certainty out of it. But your body still reacts as if immediate action might restore safety. So when a losing trade keeps ticking lower, the discomfort grows. And instead of calmly following your invalidation level, you become more vulnerable to irrational decisions. You move the stop, reduce the position too late. Add to the loser. Search social media for reassurance. Refresh the chart on a lower time frame just to find a reason not to exit. At the same time, a winning trade creates its own version of stress, not the stress of damage, but the stress of exposure. You become hyper-aware that the market could take the profit back. So even though the trade is working, your system pushes for closure, not because closure is objectively correct, but because certainty feels better than open-ended gain. This is why many traders accidentally train themselves into terrible habits. Every time you close a winner early and feel relief, your brain learns that the behavior helped. Every time you avoid closing a loser and get even a small bounce, your brain learns that holding on was justified. That learning is powerful, even when the long-term result is awful. Your brain does not automatically reward what is profitable over time. It often rewards what reduces discomfort right now. That single fact explains a huge amount of self-sabotage in trading, and it also explains why willpower alone usually fails, because by the time you're in the emotional moment, you are not standing outside the pattern making a clean decision. You are already inside the reaction. A lot of beginners think bad trading results come from dramatic mistakes, a huge revenge trade, a blown account, a wild, over-leveraged gamble. Sometimes that happens, but more often, accounts get damaged quietly. A good setup is cut at 0.5 R because it felt heavy. Another winner is closed early because the last time a trade pulled back, it stopped you out. A loser reaches the planned stop, but you move it because the level still looks valid. Then the next trade gets managed with extra caution because now you're annoyed. A winner is taken too fast again. A loser is held too long again. Nothing here looks catastrophic in isolation. That's why it goes unnoticed. But over a month, the effect is massive. Your average winner shrinks. Your average loser expands. Your strategy's edge disappears, not because the setup stopped working, but because your behavior changed the math. This is one of the hardest truths in trading. You can have a profitable strategy and still produce losing results if your execution keeps distorting expectancy. Expectancy is just the long-term relationship between your wins, your losses, and how often each happens. If your system is built to make, for example, 2 units on winners while risking 1 unit on losers, that balance matters. The moment you start taking 1 unit on winners and losing 2 on losers, you're no longer trading the strategy you tested. You're trading a stressed-out version of it. And stressed-out strategies rarely survive. This is also where trust begins to break down. First, you stop trusting your exits. Then, you stop trusting your entries. Then, you stop trusting the strategy. Then, you stop trusting yourself. And that creates a dangerous cycle. Because when you lose trust, you start interfering even more. You become more reactive, more cautious in the wrong places, more aggressive in the wrong places. The chart starts to feel hostile. Every trade carries extra emotional weight. Now it's not just about this setup. It's about recovering confidence, proving you're still capable, trying to get back to even. This is how a small execution leak turns into a full identity problem. You don't just feel like you made a mistake. You start feeling like you are the mistake. But this is exactly the point where understanding the mechanism matters. Because if you misread the problem, you'll try to fix it with more motivation, more pressure, more self-criticism. And none of that solves the thing actually causing the behavior. There's a brutal question traders rarely ask themselves. What if your actual strategy is not the one written in your journal? What if your real strategy is this? Take profit when anxiety drops. Hold loss until pain becomes unbearable. Intervene anytime uncertainty rises. Because for many traders, that's what's really happening. They may have a plan on paper, but in live conditions, their true decision framework is emotional relief. This is why the same trader can talk about risk-reward, probabilities, and patience, and then completely ignore all of it in the middle of a position. The written strategy and the acted strategy are not the same thing. If relief is driving your decisions, several patterns show up. You start staring at the P and L more than the chart. You feel an unusual urge to do something when nothing in your plan has changed. You want certainty before holding, which is impossible. You keep negotiating with your rules once money becomes visible. You judge a good trade as bad because it lost, and a bad trade as good because it won. That last one is especially destructive. If a trader breaks rules, takes profit too early, and the market later reverses, they feel validated. They think, see, good decision. But the outcome doesn't prove the decision was good. It only proves that this time, the market happened to reward it. The same thing happens with losers. If you hold past your stop and the market comes back, you feel rescued. And that rescue is dangerous because it teaches your brain the worst possible lesson, that rule-breaking works. This is how bad habits become deeply rooted. Not because they always work, but because they work just often enough to stay alive. And over time, relief-seeking starts shaping your identity as a trader. You begin to confuse emotional comfort with good judgment. You think calm means correct. You think discomfort means danger. In reality, Some of the best decisions in trading feel uncomfortable while you're making them. Holding a valid winner according to plan can feel uncomfortable. Closing a loser exactly where you said you would can feel uncomfortable. Not interfering can feel uncomfortable. That discomfort doesn't automatically mean something is wrong. Sometimes it means you are finally refusing to let emotion run execution. One useful way to understand this is to realize that the critical trade decision often happens before the trade even starts. If your exit rules are vague, your emotional brain will fill in the blanks later. If your stop is based on "I'll know when it's invalid," you're giving your future stressed self way too much room. If your target is flexible in an undefined way, fear will usually pull it closer. If your position size is too large for your nervous system, every tick will feel louder than your strategy. A lot of emotional execution problems are actually planning problems in disguise. That doesn't mean the plan needs to be perfect. It means the plan needs to reduce decision-making when pressure rises, because the live market is a terrible place to negotiate with yourself. The more decisions you leave open during the trade, the more likely those decisions will be made by fear, hope, or the need for relief. And once that starts, logic becomes very easy to bend. You'll notice this if you watch your own language during a trade. Before entry, you speak in rules. After entry, you start speaking in exceptions. This trade usually goes to target, but this one feels weak. My stop is here, but maybe this needs more room. I normally hold for the full move, but the market feels choppy. Sometimes an exception is valid. Markets do change. Context matters. But most traders are not making high-level contextual adjustments. They are emotionalizing the trade and then calling it discretion. That distinction matters. Discretion is not the same as discomfort dressed up as sophistication. So if you want to stop cutting winners and holding losers, one of the most important things you can do is tighten the structure around the moments where you usually unravel. Not to become robotic, not to remove all judgment, but to stop asking your most emotional self to make your most important decisions. When traders hear practical advice, they often want something advanced, something impressive, some deeper framework that feels powerful enough to solve a painful problem. But usually the fix starts with simpler rules than people expect. For example, define the trade before you enter it in a way your future self cannot easily twist. Know where the trade is wrong. Know where the trade is right. Know what conditions allow management changes. Know what conditions do not. If possible, use hard stops and bracket orders so part of the decision is already automated. That matters because hesitation is where emotion enters. Another powerful adjustment is reducing the amount of open discretion in your winners. If your biggest issue is grabbing profit too early, create a rule that prevents impulsive exits. That might mean no manual profit taking before a certain level is reached. It might mean scaling out only at predefined areas. It might mean committing to hold the full size until price reaches one risk unit, then reassessing. The exact rule depends on your strategy, but the principle is the same. Don't let fear improvise your exits. With losers, the rule needs to be even harder. Never move a stop farther away from risk after entry. That one rule alone can protect traders from enormous damage. Because once you allow yourself to widen risk in the moment, you open the door to endless self-deception. You can always invent another reason, another level, another possibility. The chart will always offer something you can use to justify staying in. You also need a re-entry mindset. A lot of premature exits happen because traders believe this exact trade is their only chance. So they cling to losers and suffocate winners because everything feels final. But if a setup is truly strong and conditions remain valid, there may be another entry later. Knowing that reduces the emotional intensity of one single decision. And then there's position sizing, which many people underestimate. If your size is large enough to make you obsess over every tick, your strategy may be fine, but your nervous system will not be. In that state, good execution becomes unlikely. Smaller size is not just about preserving capital. It's about preserving decision quality. This is why some traders suddenly become disciplined when they reduce size. They didn't magically become wiser. They simply lowered emotional noise enough to follow the plan. A trader can't improve if every review is based on outcome. That sounds obvious, but most people still do it. Winning trade? Good job. Losing trade? Something was wrong. That approach keeps you stuck because it teaches you to judge decisions by what happened after, not by whether the decision matched the plan. A better review sounds different. Was the entry valid by rule? Was the risk defined before the trade? Did you interfere with the trade for emotional reasons? Did you take profit because the plan called for it, or because relief felt good? Did you hold the loser because the setup was still valid, or because closing it felt bad? These questions matter because they expose the real source of inconsistency, and when you review this way, you start noticing patterns that are hard to see in real time. You may realize you almost never cut winners early when size is small. You may realize you tend to hold losers longer after a previous loss. You may realize your execution breaks down most when you're focused on a daily profit target, trying to force the session to mean something. That information is valuable, not because it makes you feel better, but because it gives you something real to change. One of the best shifts a developing trader can make is to start rewarding rule following more than P and L. If you took a full stop exactly where your plan said to, that is a successful execution, even if it lost money. If you took profit early from fear and happened to avoid a reversal, that is poor execution, even if it made money. This is hard emotionally, especially at first, but it's essential, because if you keep praising yourself for outcomes and ignoring process, you will reinforce the exact behavior that keeps cutting your edge apart. Over time, this kind of review helps rebuild trust, not blind confidence. Trust. The quiet kind that comes from knowing, even when the trade was uncomfortable, I still acted according to plan. That matters far more than one green or red result. There's one question that can stop a lot of bad decisions if you ask it honestly in the moment. If the P and L were hidden, would I still make this choice? That question is simple, but it reveals a lot. If you want to close the winner, but the chart hasn't reached any planned exit and nothing in the setup has changed, then what are you reacting to? Usually the answer is the money on the screen. If you want to keep holding the loser, but price has already hit your invalidation point, what are you protecting? Usually not the trade. Your ego, your hope, or your desire not to lock in the loss. The P and L changes the emotional meaning of everything. A small chart fluctuation can feel huge when it translates into dollars. And when that happens, your decisions stop being about structure and start being about emotional pain or emotional temptation. So when you ask, if I couldn't see the money, would this still be valid? You force yourself back toward the actual logic of the trade. It's not magic. It won't make you emotionless, but it creates a brief pause between impulse and action. And sometimes that pause is enough to notice that nothing has actually changed except how you feel, enough to leave the winner alone, enough to cut the loser where you said you would, enough to protect your edge from one more emotional override. In trading, small pauses can create huge differences over time, because the account is rarely destroyed by one feeling. It's destroyed by 1,000 decisions made in service of that feeling. A lot of traders expect improvement to feel good, more confidence, more certainty, more calm. Sometimes that happens, but often, real progress feels strangely uncomfortable at first. When you start holding winners according to plan, you may feel more anxious, not less. Because now you are resisting the urge to grab relief. When you start cutting losers on time, you may feel exposed. Because now you are accepting pain without negotiation. When you stop watching every fluctuation and let the trade play out, you may feel out of control. Because your old habit was constant interference. That's normal. You're not trying to become comfortable with every trade. You're trying to become trustworthy in how you execute them. That is a different goal. The developing trader often thinks, once I feel better, I'll follow my rules. In reality, it usually works the other way around. You follow your rules while feeling uncomfortable, and over time your system learns that the discomfort is survivable. That is how behavior changes, not through one motivational moment, not through self-criticism, not through promising yourself that next time will be different, through repeated evidence. Evidence that you can let a winner breathe without panicking. Evidence that you can take a stop without collapsing emotionally. Evidence that uncertainty does not require immediate action. Evidence that discipline is not a personality trait, but but a structure you practice. This is where a real mindset shift begins. You stop measuring success by how good a trade feels while it's happening. You start measuring success by whether your behavior remained aligned under pressure. And once that shift takes hold, something important changes. The market stops feeling like a constant test of your worth. It becomes what it always was, an environment of probabilities where your job is not to control outcome, but to control execution. At the center of all this is one principle that can quietly change everything. You do not manage profit, you manage decision quality. That may sound small, but it separates stable traders from emotional ones. If your focus is profit, your emotions will swing with every fluctuation. You'll protect open gains too aggressively. You'll resist realized losses too stubbornly. You'll keep asking the market to make you feel safe. But if your focus is decision quality, the frame changes. Now the question becomes, was this action valid by plan? Not, did it make money? Not, did it feel good? Not, was it relieving? Just, was it valid? That perspective doesn't remove emotion, but it puts emotion in the right place. It becomes something you notice, not something you obey. And this is the irony most people only understand after a lot of pain. The trader who becomes less obsessed with protecting each individual outcome is usually the one who gets better outcomes over time, because they stop strangling winners, because they stop feeding losers, because they stop treating each trade like a verdict on their intelligence, because they finally understand that the market is not asking them to be comfortable, it is asking them to be consistent. So if you keep cutting winners and holding losers, don't reduce the problem to laziness or weakness. Look deeper. Look at where your plan becomes vague. Look at where your size becomes too loud. Look at where relief starts making decisions. Look at where you praise outcomes that came from bad process. Look at where your nervous system is pulling you away from your edge. That's the real work. And once you start seeing those moments clearly, trading changes. Not because the market becomes easier, but because you stop handing control to the part of your brain that only wants immediate relief. That's when you begin to trade like someone who actually understands the game. Not as a search for comfort, but as a commitment to better decisions, one uncomfortable trade at a time. If you got value from this video, please hit the like button and subscribe to the channel. Chasing Candles breaks down the real battle in trading, the one happening inside your own mind. Subscribe for more videos, and I'll see you in the next one.